Hi, everyone, and welcome to our third quarter market update. The past few months have been eventful, with strong gains across both stocks and bonds, a key move from the Federal Reserve, and some shifting trends in the broader economy. Let's take a look at what's been happening and what it might mean going forward. The Federal Reserve cut interest rates by 0.25% in September, bringing the Fed funds rate down to a range of 4 to 4.25%. The Fed is walking a fine line, trying to keep inflation under control while also supporting the job market. Growth has softened this year, but the Fed expects things to pick back up in the first half of 2026, partly helped by higher tax refunds tied to the new tax law. Inflation has nudged higher recently, reaching 2.9% year over year in August. It's expected to climb above 3% by year-end before easing again by late 2026. Unemployment is still low at 4.3%, but we're seeing some cooling, fewer job openings, and slightly higher layoffs. Slower job growth has been balanced out by a drop in immigration, which has kept the unemployment rate fairly steady. The stock market kept its momentum going in the third quarter. Global stocks were up about 8%, and since the market bottomed back in April, U.S. large caps have climbed more than 30%. A few key factors have powered this rally: growing optimism around interest rate cuts, a rebound in big technology company performance, and continued strength in consumer spending. International markets have also been a standout performer this year. Lower starting valuations, supportive fiscal policy, and a weaker U.S. dollar have all helped push returns higher. In fact, for U.S. investors, currency effects alone have added roughly 9% to international stock returns. Here at home, large-cap U.S. stocks rose about 8% last quarter, and small caps did slightly better, up around 9%. S&P 500 earnings grew 12% in the first half of the year, and are on track to finish up 10 to 11% for 2025. Valuations, though, have risen faster than earnings, meaning prices are now a bit ahead of profits. Tech stocks, especially the companies known as the Magnificent Seven, made a big comeback from the lows of early April. Overall, they've averaged 20% annual earnings growth over the past 4 years, compared to about 10% for the rest of the S&P 500. However, this gap is narrowing, and we expect it to continue to do so into 2026. Bonds also had a solid quarter. U.S. core bonds returned roughly 1.5% to 2%, and municipal bonds were up about 3%. For the year, U.S. core bonds have returned 5.5% to 6%, thanks to starting yields around 4% to 5%, combined with price gains as interest rates have come down. The yield curve, which was inverted a year ago, meaning short-term rates are higher than long-term rates, has now shifted to a more normal shape, with long-term yields higher than short-term yields. That means investors who have moved from cash into longer maturities are seeing higher income now. We expect this difference between short and long-term yields to potentially widen a bit over the next year as short-term rates continue to come down. It's important to remember that when you own longer-term bonds, even though they may have higher interest rates, they also have more sensitivity in terms of how their prices can move as interest rates fluctuate. As we think about what bonds might return over the next 5 or so years, history has shown that starting yield is a good predictor of future returns. Thus, investors may see 4 to 5% returns on average. So what's the big picture? Despite plenty of uncertainty around policy and the economy, markets have delivered strong, broad-based returns this year. Diversification has paid off, and rebalancing has helped investors stay aligned with their long-term goals. As we head towards year-end, it's worth noting that stocks have strong momentum, but also elevated valuations. Now is a good time for investors to review their portfolio, making sure the investments still match up with their long-term goals and the amount of risk they are comfortable taking. At our firm, we continue to focus on the disciplined, long-term plans we have built for clients. The consistent implementation of these plans through both highs and lows is what we believe leads to lasting success over time. Thanks for watching our Q3 market review. We'll see you next quarter.